All right, community, you win. I can't drag this out any further. It's finally time for my ETF review of none other than SPMO. Seriously, this has been the most requested ETF review in my comments for well over a year now. And let's get real, it's for good reason. SPMO has been an absolute beast since inception, and today we're going to dive deep on everything you need to know to decide if it deserves a spot in your portfolio. We'll look at how it's built, all the key metrics that matter, and how it stacks up against the big dogs. If you're new to the channel, welcome. My name is Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please body check that like button, subscribe if you haven't already, and drop me a comment below with anything that comes to mind. And before we dive in, you can become a channel member if you like videos like this and you want to support even more. I usually plug my Seeking Alpha and Snowball Analytics here, which I guess I just kind of did in a way, links in the description below. But I think I'm going to start putting that one at the end of the videos, and I'm going to promote my channel membership more because I have some fun ideas for that one. You know what time it is. Let's grow. SPMO Methodology. Before we dive into the numbers, let's talk about how SPMO is built and where I have questions. You've probably seen me voice skepticism over strategies relying too heavily on one single investing factor, and momentum is especially tricky. It can be incredibly powerful when trends are strong, but it can also fall out of favor quickly depending on the market environment. With that said, there is no doubt that SPMO has crushed it since inception, delivering ridiculous total returns. But part of that is because the kind of stocks momentum strategies tend to pick have been on a winning streak over this stretch. SPMO seeks to track the S&P 500 Momentum Index, and here's how it works in plain English. It begins with all of the stocks from the S&P 500 available. That's 500 of the largest US companies. And then it calculates a momentum score based on the last 12 months of performance. The recent months get weighted more, but it does exclude the very most recent month just to make sure that it's not skewed on recency bias. And then it ranks them by that momentum score, and it sorts from strongest to weakest. And from there, it selects the top 100 stocks based on momentum. And then it weighs the holdings by a combination of the market cap and the momentum strength. So the stronger the recent trend, the more weighting it gets trickled into it. The portfolio is rebalanced 2 times per year, once in June and once in December, to capture all the changes in the market and to grab those new momentum leaders. And one of the things that make this one interesting is that there are no sector caps. That means if momentum is heavily concentrated in one area, like technology or communication services, the fund can end up leaning hard into that sector. SPMO limits itself to around 100 holdings, which makes it naturally more concentrated than something like the S&P 500. For example, right now the top 10 holdings in SPMO make up 54% of the ETF, whereas the top 10 holdings in VU, the S&P 500 ETF, are about 39%. This is part of why SPMO can look like a rocket ship when momentum is in favor, but it's also why it behaves differently from a traditional S&P 500 fund. Let's move on to the good stuff. Key metrics. SPMO is interesting because it's kind of a hybrid. It's not your classic cornerstone market index like the S&P 500, but it's also not a pure growth play like VGT, QQQM, or SCHG. It sits somewhere in the middle, leaning into momentum while still tracking a slice of the S&P 500. We'll compare it to both sides, the foundational broad market ETFs and the top growth-focused options. First, let's pull up SPMO and Seeking Alpha to view the key metrics that matter the most. We got her pulled up here, and you can see that it's the Invesco S&P 500 Momentum ETF. And I started here on the Summary tab. The things I care about on this one, and wow, usually I don't go here, but the 1 year is 28%. That's crazy. It's done really, really well this year. But I started here at the expense ratio, and you can see here that with 13 basis points, I think that's a very reasonable expense ratio for an ETF like this, not just a passive market index like the S&P 500 or total market like VTI. This one has a little more going on, so 13 basis points, very, very reasonable. And it has a nice $13 billion of assets under management, meaning this thing is well funded and not going anywhere. And now bouncing out to the holdings breakdown. As I look at the sectors here, I don't see any red flags. Technology is at 35%, which is getting up there, but it's still a lot lower than SCHG and QQQ by 15 or more percent. And then you have financials at 20, communication at 16, industrials at 10, consumer defensive at 6, and consumer cyclical at 5. And then when we bounce down to the top holdings, very recognizable names. And I should mention, this thing just went through a rebalance. It is in March and September. I said that wrong earlier in the video, and I probably threw up a correction thing there. I believe I said June and December. That was my bad. But this thing did have some adds and drops recently. But you can see the top 10 holdings: Broadcom, Nvidia, Meta, JP Morgan, Netflix, Palantir, Oracle, Walmart, Visa, and GE Aerospace. And these top 10 companies do make up 54% of the total. Again, not too alarming for a typical growth ETF. And the number of holdings is right there around 100. I do like that the very top company, Broadcom, is under 10%. So again, the balance reminds me, once again, of a hybrid between the growth ETFs, which run away even more with their top holdings, and VU, which comes in a little lower. I think the balance of these top 10 holdings are pretty solid here, and the concentration risk isn't too bad. Now, I don't even know why I hopped out to the dividend tab. Clearly, we're not a dividend fund here, but I always do this even for the growth ETFs. You can see it has a 0.64% yield, and apparently the trailing 12 months makes it the best fund of all time. But when we zoom out to the 3-year CAGR is flat, 5-year CAGR is 2%, and the 10-year isn't established yet. It does have 9 consecutive years of payment, 0 years of growth. Again, we could probably move on from this. But before we do that, we got to check out, oh yeah, and you can see this bad boy's all over the map. I just went to the 10-year dividend growth, and well, let's move on to the next section and assume we're not investing in this thing for consistent dividends. Okay, we popped out to the charting tab, and now we're cooking with fire, ladies and gentlemen. I have this bad boy set to year to date, and you can see we're on total returns, and that's great. I don't want to throw shade just for the sake of it, but now I can understand why some newer and more short-term focused investors love SPMO, because this bad boy is dominating on the year to date. What I've done here is I've put SPMO here, the ETF that we're reviewing, and it's at 27%. And then I went with the growth peers. It's ahead of VGT, QQQ, and I used this one instead of QQQM so we can zoom out more. They're about the same though. And SCHG by a wide margin year to date. And it's also ahead of VU and VTI. So besides VGT and QQQ, this thing is doubling the competition. And when we zoom it out a year, we expect similar results because we are here in October, and you can see it's at 29% over last year. VGT made up a little ground, 24. I'm thinking this one's going to pass it long term when we zoom out. I do this live with you. I have not looked ahead. QQQ at 23%, so it's just losing to VGT there. SCHG at 20, and then the market, VU, and the broader market, the whole US, VTI, are at 14.75 and 14.61 respectively. SPMO still running away with this thing. Let's scooch it out 3 years. And wow, okay. So SPMO's up 134%. VGT did pass it at 145. QQQ and SCHG are still falling just short of SPMO at 127. And this is known. This is nothing crazy. We know that VU and VTI are roughly a 50-50 mix of growth and value, whereas these bad boys are more growth oriented. And growth has dominated lately, of course. But anyway, VU comes in at 88%, and it's just ahead of VTI at 84. Okay. When we scoot out 5 years, SPMO 151 to VGT's 141. Now that is impressive. And it's crushing the Qs and SCHG, which come in at 117. Wow, that's unbelievable. And then the market's actually fairly competitive with these broad growths at 108. And VTI struggling a little bit compared to the S&P 500. I've always liked VU more personally, and VTI is at 99%. Okay, we do have 10 years. I knew that SPMO was about 10 years. I'm just looking at this 3647 compared to 3647. So we do have the full 10 years. I love that. No custom ranges needed. So zooming it out 10 years, which I believe is close to the inception of SPMO. Actually, I think it might be really close. SPMO's at 430%. That is very impressive. Yeah, and I figured this would happen. VGT, I do consider this a superior long-term growth holding, comes in at 646%. So it's ahead by a couple 100% there. QQQ outdoes SPMO as well at 474. And SCHG comes just shy at 409. And you can see, of course, all these growths have destroyed the market, which is still a very impressive 279, and VTI there at 262. This is well above the 100-year CAGR of the market over the last 10 years. And the growth has just been that much better. We are in a huge bull run for the growth market. But SPMO looking very solid across the board. I am highly impressed that it's even sniffing these big boys. SPMO looks great, but is it the right fit for your portfolio mix? Portfolio fit. If you've been around the channel for a while, you know that I'm a fan of building a balanced portfolio mix that holds up in a variety of market conditions. I dollar cost average into my target allocations, and that approach only works long term if you're mixing value and growth in a way that truly complements each other rather than just overlapping. That said, I think SPMO slots nicely into that half growth, half cornerstone slot. And just to elaborate on that, and I probably won't win any awards for this spreadsheet, but I converted the fund overlap by weight that we've been using with the dividends just to track SPMO instead. And you can see here the fund overlap. We have SPMO as the main player here, and then we're seeing how it overlaps with all these growth ETFs and this cornerstone. And you can see 31% weighted overlap with VU, 31 with QQQM, 29 with SCHG, and 24 with VGT. Like I said, this thing, it's very similar to VU and these growth ETFs. It's quite the hybrid. And then the PE ratio tells the same story. You have VU, which has more value in it, at about 27. SPMO's comes in at 32. And then these growth ETFs are anywhere from 34 to 37. So again, you have your cornerstone. Somewhere smack dab in the middle, you have SPMO. And then you have the more growth-oriented, so higher PE ratio. And this is the trailing 12-month PE ratio with the growths. Here's a quick example. Let's say your portfolio looks like this. You have SCHD for your value, VU, the S&P 500, for your cornerstone, and SCHG for your growth side. If you wanted to add 10% SPMO to the mix, I wouldn't touch SCHD. Instead, I'd reduce VU and SCHG by 5% to make room. That keeps your overall portfolio metrics relatively steady while adding a new layer for momentum exposure. But before you decide if that's for you, let's put this thing to the test. SPMO versus the big dogs. It's time to see how SPMO stacks up against some of the biggest names out there in a realistic investing scenario. I'm going to use Portfolio Visualizer to run a backtest and compare SPMO to 3 heavy hitters, my 2 favorite indices, VU and QQQ, and my favorite growth ETF, VGT. Here we are on Portfolio Visualizer, my favorite site to backtest portfolios like the scenario we're doing today. And you can see here that I put SPMO, our featured ETF, as portfolio 1. And you can see it's 100% down here, SPMO. QQQ, again, I use this instead of QQQM because it has all the history. QQQM, lower expense ratio is the one you should actually invest in unless you're doing option stuff, but it's not as old, so you can't look back as far. It's portfolio 2 at 100%, and then VGT, my favorite growth that I've heavily invested in personally, is portfolio 3 at 100%. And then I specified VU as our benchmark ticker. So we get to see it against my 2 favorite indices, VU and QQQ, and my favorite growth. SPMO has some stiff competition here. And if we pop over to settings, I'm going to pull as much data as possible, and I think it's going to start from 2016 because I think the inception date was sometime in 15, and they always take the first full clean year. We're going to include year to date because that will help SPMO, and that'll just put in the 2025 so far. And then we're going to be high rollers this time. $100,000 plopped in this thing, and we're going to contribute $1,000 a month. So nothing too crazy, but a little bit of fun to see some spicy numbers. And we're doing monthly contributions. Rebalance doesn't matter because there's only one fund per portfolio. Reinvest dividends is on, of course. We gotta let this thing compound. And I think that's all that matters here. It is. Let's get physical. And we can see that we did indeed pull from January 1st, 2016 through year to date, which as I record this is 10/16/2025. That was yesterday. I'm recording a little early this week. We're starting down here with the performance summary. And again, this is the first time I'm seeing this with you. I love to do these live. And it's about what I expected, actually. We can see that SPMO crushed the market, VOO, at 859,000 compared to an ending balance of 639,000. It did fall just short of QQQ, although really close. QQQ in there at 910,000. And the VGT does run away with the long-term crown at 1,144,000. You know, I gotta say, this feels good because a lot of people scream in my comments that SPMO has outperformed VGT since inception, and I always say no, but it's just the weirdest fan base. But still, I can see why, because lately it's been good, and it is very solid over time. I mean, I'm very, very impressed. We'll get into the CAGRs later. Standard deviation, it does come in between the market, which is the best, the lowest at 15.2. It's at 16.2, and then these growth ones are really high, 18.5 and nearly 20 for VGT. And that's just the sporadic nature of the returns. Not necessarily bad, quote unquote, but big ranges of returns. And then we don't have to go over all the best years. And I will go over the worst year. This is very impressive. So far in the early stages, that momentum strategy has only lost 10.5% in the worst year. And you can see these other growths and even the market lost a lot more than that. I'm guessing this is 2022. I know these are 2022 because I've done enough backtests to know. And I'm guessing this is 22. We'll see later. You can see with the portfolio growth, as I scooch along here, the growth started to pull away here, and SPMO is struggling a little by comparison. It's the dark blue one. But then you can see it reels them in 22, wow. And then even recently, that's where it started to catch QQQ. It's done pretty well in good and bad markets, I have to say. It'll be interesting to see this play out in the future. The annual returns here, this is always fun to look at. So SPMO is the blue, QQQ the green, VGT the boring gray, and teal is the market, VOO. And we won't look every year. You can see the market actually started out pretty solid in 16. 17, they were all popping. 18, where's that worst year? It is 2022. A very good, a very solid worst year. Geez, barely worse than SCHG was like -3%. It would be here. SPMO closer to SCHG than it is to these counterparts on a bad year. That is very interesting. Love to see it. You can see I'm trying to look. It never really pops quite the same. I guess it has the last 2 years. It's just pretty consistent. I'm actually impressed by these annual returns. Now here's where we zoom out and see the complete story. And specifically the annualized return section here shows how they perform. So SPMO is up a monstrous 18.6% in the full duration. QQQ is just under 20%. VGT is up there at 23%. And the market is a staggering 15%. It has been an amazing nearly 10-year run for all these holdings. I mean, the historical average of this is 10% over the last 100 years. So very impressive stuff. And most investors have done pretty well. We can argue until we're purple about who has the best setup, but I think we'll all take 15%. And then when we look at the 5-year return, that's where SPMO is actually the king here at 20.6%. Second place is VGT at 20. And then 3 years shows a similar story. Yep, it is the king at 35.41, just outperforming VGT at 35.33. That's a close one. And then over the last year, SPMO's ran away with it. And again, now I get those comments. I know people love the recency bias. And I'm not hating. I mean, good on you if you had SPMO. It's just the comments are making a lot more sense to me now. SPMO is a solid ETF with a unique profile, and I'm genuinely excited to watch this one moving forward. And for the record, I don't personally own SPMO, but that's not because I don't like it. I plan to circle back and do an update on this one in a couple years when a full market cycle is played out. And before we go, I'd like to give a huge shout out to my new channel member, Less is More. First of all, I love the name. And second, I really appreciate your extra level of support. And a huge shout out to all of you on the screen now that have been here all along. I plan to put more emphasis into the members moving forward, not just comment priority and these shout outs, but looking for other ways to provide some value while making it sustainable. Either way, I appreciate each and every one of you. If you want to explore ETFs in depth like I do in videos like this, Seeking Alpha is what I use to gather the information. I'm a long-time Seeking Alpha user. It well predates this YouTube channel. I used to use other people's links. But if you're looking to dive into Seeking Alpha, hit your boy up, use my link, because it will save you money, which genuinely is the most important step, but it also supports the channel because I'm an affiliate. And check out one of these 2 videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you in the next one. Peace.